Are mortgage rates finally cooling off, or is this just another calm before another storm? Did a surprise rally in Japanese bonds just trigger a ripple effect in U.S. Treasuries? And what are the home price indexes really telling us? Well, hey, I'm Mike Petras with MPRE Boise, powered by NextHome Treasure Valley. And while I serve clients across the greater Boise, Idaho area, this update covers the mortgage market on a national level, with real implications for anyone buying, selling, or investing right now. But before we dig in, do me a favor, hit that like button, hit the subscribe button, and hit the notification bell so that you're constantly in tune with these videos that I do come up with. And feel free to share this with anyone trying to stay sharp on what's happening in the economy and real estate today. So let's go ahead, let's recap what happened during this week in mortgage interest rates. And was it a quiet victory for borrowers? Well, even though this was a holiday shortened week, that didn't stop the mortgage market from quietly pulling off a win. After 3 straight days above 7%, the first time that's happened since February, the 30-year fixed rate finally broke its mini streak. And by Friday, it had settled at 6.95%, which is down 0.12% from the week prior. Jumbo loans even eased to 7.06%, 15-year fixed dropped to 6.21%, and government-backed loans like FHA and VA also softened slightly to 6.45% and 6.47% respectively. The drop wasn't dramatic, but after weeks of painful volatility, even a small retreat is a welcome reprieve, especially for borrowers trying to time a rate lock. So what moved the rates this week? Well, if you're watching inflation data or Fed commentary for clues this week, you probably missed the real show. And it actually started overseas. Japanese bonds spiked early in the week, setting off alarms about global bond market volatility. But by Tuesday, Japanese yields sharply corrected and treasuries rallied modestly in response. The connection? Well, it's questionable. Historical charts show little correlation between Japan's bond market and ours. But hey, markets need a narrative, right? Well, back home, weaker than expected durable goods and corporate profit reports, plus concerning signals in the consumer confidence labor market data, help push bond yields lower. The 10-year Treasury dropped to 4.399 by Friday, its lowest closing level in 2 weeks. Mortgage-backed securities also responded in kind, and lenders followed suit with incremental improvements. The biggest takeaway, though, it wasn't a blowout week for rate relief, but we avoided new highs, and in my book, that's a win. Well, what about the PCE report? Yes, the PCE, one of the Fed's favorite inflation gauges, came in right on target. Core PCE just rose 0.1% month over month and 2.5% annually, exactly as forecasted. Actually, a little bit better. Sounds like a non-event, right? And yet, markets barely budged. And why? Because again, the narrative has shifted. Traders are more interested in what's coming next, specifically whether tariffs will sneak inflation back into the system this summer. So while Friday's inflation read didn't move the needle on its own, it reinforced the idea that we're in a holding pattern. The Fed's not ready to cut, and the market's not ready to celebrate yet. What about home prices? We did briefly touch upon that. Is it flatlining or flashing warning signs? Well, let's circle back to the home price indexes. The FHFA and Case-Shiller reports came out this week, and while they're always 2 months behind, the data's for March, they still tell a compelling story. Well, on the surface, both reports show prices more or less holding steady, but dig deeper and the cracks start to show. The FHFA index just slipped negative 0.1% month over month. Nothing too alarming, especially since it's seasonally adjusted, but the Case-Shiller National Index, once seasonally adjusted, posted a negative 0.3% drop, the first decline since early 2023 and one of the steepest since 2022. But only 6 of the 20 metro areas tracked saw gains. Year over year, prices are still rising, but the pace is slowing. So the big question is whether this is a blip tied to a seasonal volatility or a sign that economic mortgage rates and economic uncertainty are finally cooling the housing market. Well, if you want to see what's going on here in the greater Boise, Idaho area, feel free to follow me at Market Mike Petras, MPRE Boise, and go ahead and see what is happening on our monthly basis in Mikey's monthly market updates. Well, the bottom line, the data isn't flashing red, but it is definitely no longer green. So should you lock or float? Well, right now, rates are behaving, but barely. We're in a zone where a few tenths of a percent make or break a deal. And if you're under contract, this may be your window. We hit 6.95% on Friday, and that's the best close in 2 weeks. And if you're still shopping, be cautious. The market remains reactive to economic data and headlines, especially anything tied to tariffs, bond auctions, or labor metrics. So you don't want to get caught in a sudden spike, so have your lender on standby. And my advice, lock when you like what you see. Don't sit around chasing perfection. So what's coming next week? Well, next week has more data heat. We're talking about ISM manufacturing, jobless claims, and May's employment report. The big one. Markets will be laser focused on wage growth, payrolls, and unemployment trends. If job numbers disappoint, we could see more bond strength and lower rates. But if the labor market proves resilient or inflation keeps creeping up again, it could easily trend rates back towards 7%. And let's not ignore global events. Tariff chatter and overseas debt market shocks still have a strange power over U.S. bonds. It's like everyone is waiting for the next tweet, press conference, or bond auction to decide their next move. So here's the play. We didn't crash through the floor, but we also didn't rocket higher. Rates coasted into the weekend near their best levels of the month, and that gives you options. But just remember, we're in a tug of war between economic data, Fed credibility, and geopolitical noise. Rates don't move on logic, they move on fear, expectations, and headlines. So if you are looking to buy, sell, or refinance, make sure you're working with a pro who understands this market in real time. And while I am a real estate agent, if you're looking for that professional lender, feel free to reach out to me today. And of course, if you're looking to make a move right here to the greater Boise, Idaho area, I'm your guy. Feel free to reach out to me. Or feel free to download my relocation guide. That can be found in the description below, or just simply scan the QR code right over here to my left. But drop your thoughts in the comments. Will next week be better or worse for rates? And don't forget to give me a like. Hit the subscribe button if you like what you saw, and hit the notification bell so that you're constantly in tune with these videos as they do come up. And I will see you next week. Same place, same truth telling mortgage update. So God bless, and I look forward to the day that I call you my neighbor.